All right, everyone. So this one is definitely more of an upgrade since the previous one. There is going to be a couple of things that you will see from the previous video, but I promise you, this is definitely a huge game changer for a lot of you, and I promise you will not regret if you stick to the end of this video. So without any more gatekeeping, let's begin. Alright, so what are order blocks? An order block is a special price level where big banks and other important financial groups put lots of buy or sell orders. They do this to trade large amounts of money. When they place these orders, they put many of them at the same price, making a big group of orders at that level. This makes it harder for the price to move through that level. Pretty simple, okay? Now, what do they look like? An order block is usually formed by the last bearish or bullish candle before an impulsive move that may or may not have caused a break of structure. The most reliable order blocks tend to have a strong body with very small wicks at either end. Longer wicks indicate more indecision in the market, and that's in general. We'll dive deeper into identifying quality order blocks and some variations shortly, but first we need to lay the groundwork. So yeah guys, typically the average or normal way to find a order block, it would be by looking at the last bearish or bullish candle. Now, when it comes to the bullish order block, you want to look at the last bearish. When you're talking about the bearish order blocks, you want to look at the last bullish candle. That's usually how it works. Now, sometimes these candles usually are the ones that cause the break of structure, like here or right here. That's usually how it looks like, but they don't always have to cause a break of structure, but when they do, those are usually the best ones. Now, what are supply and demand zones? Supply and demand zones consist of order blocks, but they are positioned in either premium or discounted areas that institutions can target on any time frame. You can easily identify these zones using the Fibonacci tool. However, keep in mind that this can be subjective, as traders often interpret premium and discounted areas differently. So the best way to make it, less subjective is to use type 1 and type 2 structures. Look at my intermediate to advanced microstructure video to tell you more about this type of structure. But for instance, for a type 1 structure, you can draw the fib from the bottom to the high, and that'll give you the overall premium and discount for the overall market. Now, if you want to know like short-term premium and discount, then you would look at your type 2 structure. So here, as you can see, I drew up my fib from the most recent low for the type 2 structure from here all the way up here, and as you can see, structure barely pierced through the median or the middle of the fib and tapped into a little bit of a discount, right? So as you can see, there are actual key differences here from using overall market structure and like the internal smaller types of structure. All right, an example here, you can see price entering a discount in a demand zone, right? So this is more of a type 2 structure. Price comes down, enters discount, and taps into the demand zone. Here, price enters a form of premium, taps into the supply zone, and then starts moving down, right? So again, if you haven't seen my intermediate to advanced microstructure video, definitely check it out. Okay, so I have noticed that a lot of people have had this question. What if my order block / zone is too big? Well, your option 1 would be you can use 50% of the order block as your entry. So as you can see here, I have a supply zone set up, right? And all you have to do is, I think there's a settings in there that you could use to turn on the middle line of the markup box, something like that. You know what I'm talking about. Just turn it on and you can just use 50% of it to sort of refine the entry, okay? Next is you can use a leading block as your entry as well. So leading blocks is, instead of using the bullish candle, right? Instead of using the bullish candle as part of your supply zone, right? Because we're in a downtrend, you can use the candle in front of it, which in this case would be a bearish candle. You can use that as your order block, right? Now, some people think that that's not how you actually draw a proper order block, but the truth is plenty of people use it like this as well. I use it like that sometimes. I've seen other mentors or your traders use this method as well. So it works either way, but preferably you would be better off doing this, right? Using the proper last, in this case, last bullish before the bearish candle. Another thing that you guys can actually do is scale down to a lower time frame, and you can refine the order block. I don't think I included it in this video because it's just pretty hard to master, and a lot of the times you can get the zone missed. So it's okay to refine, but I don't really recommend it starting off as a new trader. Definitely back test after you've gotten comfortable using just order blocks on the current time frame that you're trading on, and then once you feel a little more comfortable, jump down to a lower time frame and then refine it. And what I mean by refining it is on the lower time frame, let's just pretend like this is a higher time frame, and let's just say that your zone is too big. You drop down to a lower time frame and you see that there's another order block or another supply zone in this case that's a little bit smaller than the one on the higher time frame. Then you can use that smaller supply zone or order block and use that as your main target or entry. Okay, now here are some key things that you need to look out for when using supply and demand or order blocks, or just trading SMC in general when it comes with this kind of method or strategy. Okay, so please pay very close attention. Drop any questions down in the comments or in the Discord, and I will do my best to answer. But definitely, these are definitely things that you don't want to miss or skip over this video. Okay. All right, so let's talk about some liquidity grabs / sweeps. Sometimes you'll encounter a liquidity grab or sweep, which is simply when price hits your stop loss before continuing in its original direction. Now, some of the reasons why this can happen is due to news events, illiquid pairs, and a few other factors. Or simply the market just wants to do what it wants to do, and it needs a little bit of extra fuel. Now, something I want you guys to understand is just because market decides to sweep some liquidity, that does not invalidate the order block. Sometimes it'll sweep liquidity or the order block by a simple wick, or candles can sometimes tap into the order block but quickly reverse off of it. So unless you see strong displacement away from the order block, in other words, big volume or bunch of candles or big candles moving away from the order block or through it, then it's more than likely just a liquidity grab or liquidity sweep. So look at this example right here. You'll see that the order block actually held up just enough to where it didn't let price break through it, and it quickly reversed. Okay, so just keep that in mind when trading. Sometimes this can happen, so make sure that it displaces through the order block. Check my video on liquidity grabs and liquidity sweeps. I'll link it down below. It'll help answer a lot of these questions as well. Okay, so very important, be cautious. Keep in mind that if a supply zone failed, then that means demands are more likely to take control, and vice versa, because the trend is probably shifting. Look for patterns that can confirm the change in trend, like a change of character, or known as a market structure shift, something like double bottoms, some kind of candlestick pattern, whatever it is that you use to confirm the change in trend. So here you can see there was some liquidity here, right? And you probably had your supply zone marked up, but what happened? Price broke through it. This is what I call strong displacement, right? And now we have the change in trend confirmed after price taps into this newly created demand, right? Comes down, taps into it, respects it, and starts moving back up. Okay, so open up a chart, try to see if you can find something like this, or if you ever notice why your supply ended up failing, this is probably why. Okay, just make sure you're also adding some kind of daily bias or weekly bias to also give you a little bit of an extra confluence to these things as well. All right, so let's get into various types of order blocks / zones. These are just a couple of variations that you might see, and just a couple of ideas to give you guys, so that way you can back test and trade, and just maybe add for a new trading plan. All right, so pay very close attention and let's begin. Alright, so for the first variation, a multi-candle order block. So on a higher time frame, this is one entire candle. So why I call it multi-candle order block is because you're using more than one candle to make the order block. Now, if you were to go on the higher time frame, this candle right here and this one right here, these two would actually make one entire candle. So I don't know if you guys have ever seen it when you're trying to refine a zone and you drop down, you'll realize that the candles end up separating, right? Obviously. So if you want, you can just simply mark up both candles just to add a little bit of an extra layer of security in case price doesn't tap into the original order block that you would have marked out. Sometimes, I don't know if you noticed, you'll mark up maybe a small order block, but it ends up getting missed and it taps the candle under it. In this case, it would be this one, and ends up like respecting it, and then price ends up moving away from it. That is one way that you can mitigate it, by marking up both candles. Okay, next, obviously the leading block. So seems to appear often in the lower time frames, like the 1 minute and down. So when it comes to these order blocks, you'll definitely find them on the lower time frame, right? And this approach can be especially helpful when you're unsure which candle to prioritize, and it can also mitigate the issue of your order block not getting tapped in due to being too small. So like I was saying earlier, guys, sometimes your candle might be too small. In this case, if you would have marked up the last bearish before the bullish candle, you would have definitely ended up having your entry missed. So sometimes it is best to just mark up the slightly bigger candle that's in front of it, making it your leading block, and obviously you may mitigate the chances of not getting tapped in. Okay, all right, so for our next one, I call this one the accumulation block. So accumulation blocks, these are small areas of accumulation that can be used as an order block, and no fair value gap or volume has to be present. A break of structure is more than enough. What I mean by volume also, guys, is usually the easier it is for structure to break. Like for instance, this one right here, this break of structure had tons of volume in it. Why? Because this candle right here, these two candles blew right past it. That's also another sign of volume, but we'll get into more of that later. There are many more types, like breaker blocks, mitigation blocks, rejection blocks, etc. But those are a little bit more different, so I won't be getting into those in this video. But they're pretty easy to find. I made a video on all of these and somehow, some way incorporating them. So don't worry, you'll see them at some point. But yeah, you can use accumulation blocks. They don't appear too often, but they do appear every now and then, and it's pretty useful to mark them up because sometimes you just don't know which candle to use, and I just recommend marking up the one with accumulation in it. Okay, so let's move on. All right, so now we are going to talk about finding high probability zones. This is extremely important, y'all. Please don't skip it. I think this is probably one of the most important parts of the video, so please do not skip it. Let's begin. Okay, so this is going to show you how you can find high volume order blocks or high volume supply and demand zones. All right, so the first method would be to use an indicator, which I will link down in the description below. It gives a great visual representation on how you can find which order block has the most volume. The more volume, the more likely it'll hold up. So if we're looking for bullish order blocks, we want to have more bullish volume. So as you can see here, these order blocks, out of all three, this one had the most. All right, so price comes down, disrespects this one, obviously ended up disrespecting this one because it ended up tapping into it here. All right, and as you can see, price obviously respected it really well and kept moving up. All right, now let's move to the next one. Now in this next method, you need to have high volume fair value gaps. So sometimes there'll be a fair value gap with a ton of volume in them and an order block right under it. You can pair these two things up, right? Fair value gaps and fair value gaps with high volume, and more than likely when price retraces into it, it'll more than likely just slightly wick out of the fair value gap to tap into the order block, right? So if you have multiple fair value gaps, just find the one with the most volume and an order block near it, and then just choose the one with the highest volume. That simple. All right, so the last method for finding high volume order blocks or zones would be by using high volume during the breaks of structure. So as you can see here, there was high volume pushment or high volume pushing on the left side of the chart, and inside of the order block was left a fair value gap. Once you see something like this with strong displacement and a fair value gap or an imbalance followed by a break of structure, usually that is a high probability area, especially if price starts making areas of liquidity. So what does price do? Comes down, take out the liquidity, taps into the fair value gap that's inside the order block. And it won't always be like this, y'all. Sometimes it'll have the fair value gap a little bit slightly over it, maybe slightly under it, but usually it's over it, and it'll somehow overlap. But once you have something like this, you have a high probability of it being respected. The next thing, or the next example, you can see here, price pushed down with a ton of volume, right? And it would be this candle right here, but it started with this candle. So if we follow the money, right, you go down, break of structure, cause this low here, comes back up, makes an area of inducement, and all that is just a fake area of buying or selling. So some people would have sold somewhere around this area, and what does price do? Come back up, sweeps their stop losses, and taps into the order block here, right? So if you are a trader and you've noticed that sometimes you'll mark up a supply zone and you see that it actually ends up getting disrespected, it's actually a way of stop loss hunting, and it was actually looking for another point of interest or another area of supply to tap into to sell off from. If you want to see something more on this, you can look at my liquidity and inducement video. I highly suggest it if you want to mitigate the losses. Okay, so let's move on. So this doesn't actually get talked about very much, but this actually happens a lot more in futures assets. So if you're trading futures and you use volume imbalances with order blocks, I can assure you that you can make a really good strategy with this. And just trading futures in general is pretty well. I've noticed that people make more profitable strategies for futures just because the market works a lot better that way. I don't know why, but trading futures is a lot better. But anyways, same thing applies here. If you have a volume imbalance with an order block either overlapping it, inside it, or near it, it's a high probability zone. Okay, so if you're trading futures and you wanted to get an extra little edge, you can check this out. Now, I'm not saying this doesn't work in Forex or any other trading venture. It just seems to work best in futures. That's all I'm saying. Okay, but you can try it out anywhere else. All right. So next is resting liquidity. Now this is actually pretty common. Many people make good money and good decent strategies. Well, not decent, really good strategies. Honestly, I have strategies like this where all you use is supply and demand with liquidity. That's it, right? So if you see there's liquidity resting near your zone, price will often retrace into the zone, taking out all the liquidity and then going back up. And in this example here, we have one with a supply, right, gets tapped in. You see the liquidity right in between it. Price sweeps it, taps into that supply zone, and then shoots down. Very easy money, guys. Back test this. I promise you, you will make pretty good money off of this alone. You can use all the other methods I've also outlined if you want, but if you want to keep these things simple, just very simple, just these two things, you'll make some really good money. All right, so next is Fibonacci levels. Now this can be any fib level, and reason why I say can be any fib level is because really the only thing that matters is that you back test and that you back test the levels that you are using. So when using fib levels, if you're looking for a specific supply or demand setup and you don't know which one to use, if you have too many order blocks, just use the one near your fib level. The one that's nearest or overlapping it, that's the one you want to use. Some people use a different type of fib level. Some use just 50%, right? If they find an order block in the 50% level, for them that's enough. But I recommend you back testing it, because if you use different fib levels, it'll definitely change the outcome of your strategy. All right, so that is just one way that you can find high probability order blocks, and it's by using the Fibonacci tool. Okay, the next thing would be using macros or kill zones. So you can use, it can be any macro, honestly, and it can be any kill zone. So in this case, I'm using the example of a macro. So the expansion macro that happens between 1050 and 1110. If you find an order block during that time frame, you can just look for a quick scalp, taps into it, right? And the reason why it makes it a high probability is because according to ICT, these are also the time frames where banks tend to make really quick transactions, right? So if you find something in a macro or in a kill zone, trading anything during those specific times, more so kill zones from what I've seen, more so kill zones, from what I've seen, they get respected a lot more. So back test it. Don't just take my word for it. Do your research, test strategies out. Maybe for you a macro might work better than for me. Okay, at the end of the day, it's all subjective. Now I know some of you might be wondering, can I use all of these things? Yes, you can use all of these things. I don't recommend it because it'll make your trading just a lot more difficult. But yeah, you can use all of these things at once. It's up to you. Back test it, but I really don't think it's that necessary, and I don't really think you're gonna last very long if you make super strict rules. Because the more strict your rules are, sometimes the better of a win rate you can get. But the problem is it messes with your psychology, because then it becomes harder to find good setups. All right, so always keep that in mind. So a lot of you might be wondering when to remove the order block or zone. I get that asked a lot. I've seen it get asked a lot. So in this video, I'm going to answer that very question. So let's begin. So one way that you can find out is if you have more than one break of structure. So as you can see here, we have one break of structure, and then we have another one. Usually after the second one, price will not retrace to your original order block. Now you gotta be careful. Sometimes it's usually just the market creating liquidity. So just keep an eye out, see what price is doing. If you see prices pushing upwards with a good bit of volume, this is usually a sign that it's not going to retrace into it. And another thing too is if you see that there's order blocks being formed at the same time, and those order blocks are being respected, then it's also another confluence to say, you know what, maybe this order block will not get tapped into. So just always keep that in mind when trading. Now another way to know is if price displaces through the order block / zone. So I briefly talked about this, but these zones can be disrespected due to a change in trend or inducement / seeking more liquidity. So sometimes guys, there's a change in trend, so you'll have maybe a break of structure here, and then it'll come back up slightly, and even then sweep the order block, and then either consolidate or actually shift in trend, right? So sometimes it'll do a little bit of everything. It'll sweep liquidity, then continue back up and break through your order block. So you got to be very careful. And as you can see here, that was the exact thing that happened as well. Break of structure towards the downside, came back up, swept the order block, came down, and then started moving back up, right? So this is just a little bit more of a refined image, okay? And as you can see here, this is another form of inducement. So let me see if I can actually zoom in for you guys a little bit. As you can see here, some people think that it was a good idea to sell from this order block, but price actually ended up tapping into the one just above it. And as you can see, price ended up coming down and ended up sweeping this liquidity here, or basically tapping into our take profit. All right, so just be very careful, guys. These kinds of things happen a lot more on the lower time frames, so always keep that in mind when trading or building a strategy relying on the lower time frames. Okay, now I also get this question a lot too. Can an order block / zone be used more than once? And the answer is yes, it can. So for some people, let's say you're trading on a lower time frame and you have this demand zone marked up, and let's just say you were probably targeting a fair value gap here, or this set of liquidity right here, right? If your bias is strong and you're maybe willing to gamble a little bit, you could have actually entered into two positions. The first entry was here, or if you missed it, you could have added a later entry down the line, which would have been here, right? And if you have two positions open, you can close the first one at the nearest area of liquidity, and then the last one could have been at the highest place where liquidity is resting in. So this could be your TP1, this could be your TP2. Now, do I always recommend you trading with two positions open? Not always. And another thing you got to be careful is that sometimes when price retests a supply demand zone, that can also be a sign of the market trying to shift direction, and every now and then it'll succeed and break through the order block on the second attempt. So just keep a very close eye to this, okay? Now I know plenty of people will ask this, so what are the best time frames to find these zones, right? So a lot of you and a lot of new people always wonder, what is the best time frame to find order blocks for supply and demand zones? And the truth is, It can be any time frame. Just remember this: the higher the time frame, the better, and the lower the time frame, the more riskier it becomes. This is because the price action is more volatile on the shorter time frames. So another thing too is that on the lower time frames, there's just simply less data. So an order block on the lower time frame is less valuable because the candle itself, for instance, on a 1 minute only has 1 minute amount of data, versus a candle on like the 1 hour, it has an hour's worth of data in one candle. All right, so for beginners, use a higher time frame starting off when trading, right? Swing trade if you have to. And for more experienced people, you can use the lower time frame. I know plenty of people that only rely on the lower time frame, nothing else. One of my recent students that I'm pretty sure, right? I hope you saw the interview that I made. He only trades on the lower time frame. I think it's like the 1 minute and the seconds time frame, and he doesn't use anything else. I believe DTFX also only trades on the seconds time frame and doesn't go above the 1 minute. I think he made a podcast talking about it. So just goes to show, guys, that the more experienced you become, the easier it is to make money. Next, multi time frame. You can pair different time frames together that fit your trading plan, but it can require more knowledge. So for example, the 4 hour and the 1 hour time frames, right? So some people will look for an order block on the 4 hour and then enter on the 1 hour, or maybe they'll find an order block on the 4 hour and refine that order block down to the 1 hour. Okay, there's many ways you can use multi time frames to trade or to set up different strategies, right? Some people use the 4 hour as their bias or their points of interest, and then they'll use the 1 hour to see like early changes in trend to get in a little bit sooner, as opposed to waiting for price to tap into the 4 hour order blocks or zones and still having to wait for like some kind of change in trend confirmation, right? So it's a little risky, but if you do it right, you can definitely make some good money. Next, stick to one. You don't need to use every time frame, just one will do. All right, so I hope you guys are back testing, and I hope you guys are using some open charts or trading viewer or something to follow along with this video, so you guys can also test out what I'm telling you. Okay, it's very important. All right, so you made it to the end of this video. God bless you, man. If you did make it to the end of this video, I would like for you to at least like and subscribe in case you forgot to do so. Join the Discord, ask me any questions that you have there. I have been adding, well, not adding, but I'm going to. It's just I've been working on so many things for you guys. I will be adding some more like special content specifically for you guys, for the people that are in the Discord, just like stuff that isn't really worth uploading because it'll be so short, or I'm afraid that I might be liable for something. So just join the Discord. You'll find some amazing stuff in there real soon, hopefully. But even then, I think the most valuable part of the Discord is people get to ask me questions and I answer. All right, so please ask questions and I'll do my best to answer. Follow me on social media, email me if you need a question there, answer through there. And yeah, so before I go, let me leave you with a little bit of wisdom. So this is from Isaiah 40:31. But those who hope in the Lord will renew their strength. They will soar on wings like eagles. They will run and not grow weary. They will walk and not be faint. God is good, man. God has a plan for all of us. If you're someone battling between the idea of the existence of a God, or maybe you have a different worldview, I suggest you check out Frank Turek on Cross-Examine on YouTube. Great content for people that have, I guess, some pretty difficult questions that need to be answered. It helped me out a lot in my journey to finding God, and I'm pretty sure it'll help you guys out. All right, please give it a shot. Actually test out Christianity from people that answer the tough questions. Okay, don't just be quick to dismiss it. Actually look for it. Okay, so with that being said, guys, that's all I have for you. God bless you. Take care, man. I hope that this video was of use to you guys. If you liked it, leave a comment down below. Thanks once again, guys. I'll talk to you guys soon. Peace.